Hello everyone, hi, welcome to the channel of Wall Street Mojo. Friends, today we are going to discuss a tutorial on shares or stock-based compensation expense and the accounting of the same. So let's first begin and see a graph over here of Amazon's, Facebook and Box stock-based Inc. Now, as you can see, it is written over here, the Box stock compensation as a percentage of the annual asset is much higher than the Facebook and Amazon. Why? So first, for the same why, we need to learn what is stock-based compensation. See, stock-based compensation is a way a company uses to reward their employees. Stock-based compensation is popularly known as ESOPs. So stock options are given to the employees to retain them or attract them and to make them behave in a certain ways so that their interests are aligned with that of all the shareholders of the company. So this particular chart compares the stock compensation as a percentage of the total assets of the three companies, that is Facebook, then you have Box Inc. and Amazon. So Box Inc. has the highest, you can see the highest stock-based compensation as a percentage of the total assets, which is close enough to 15.88%. See, Amazon and Facebook on the other hand have the ratio as 4.95 and 3.57%. So what does this mean? What does this mean for Box? How does the shareholder compensation flow affects the financial statement, balance sheet, income statement and cash flow? So in this particular tutorial, we'll look at stock options and the share-based payment in complete detail. So let's get into the nitty-gritty of the same. The first and the foremost thing what we are going to do, we are going to learn is about the introduction portion. So let's see what all things are there. See, stock options basically allow their employee stock option to buy specific amount of shares at a very predetermined or very specific price, you can say specific price, and stock options are allotted to specific employees. So stock options are different from other options which are available for the investors to buy and sell on exchange platform. The difference being that a stock option is not available for investor and it is not at all traded on the exchange platform. So as we have noted earlier that stock options are given or rewarded due to specific employees of the company. So one of the reasons behind giving a stock option to employees is to retain them or attract them and to make them behave in certain ways so that their interests are aligned with that of all the shareholders of the company. The employees of the company must wait for some specific period before he or she can exercise the option to buy the company share at a predetermined price. So this waiting period is basically called as vesting period. This is very important. Now, the vesting period. See, the vesting period also motivates the employees to stay with the company till the vesting period is over. So how the stock options agreement works? Let's take an example. A top executive company to whom the company has rewarded a stock option around, let's say, 1,000 shares. The company allows its top executive to exercise his option only after 3 years. So this shows that a company can use the waiting period or vesting period as a motivation for its employee to stay with the company. Now, what is the reason behind this? The reason behind vesting before an employee can exercise his or her option. The reason being behind the waiting is to align, very important, this is align the interest of the company's employees and the shareholders. So any shareholder investors in the company wants their share price of the company to increase. Therefore, rewarding the options to employees while the share price increases keeps the interest of the both employees and the shareholders in alignment. So this waiting period for the employees also ensures that he or she is not able to sell the shares immediately after buying, and if the majority of the options are immediately exercised and sold, it can put a pressure on the stock of the company which might lead to downfall of the stock. So the downfall of the stock might not stop the investors to realize that the reason behind this downward pressure is that the company's employees are increasingly selling their option, which can lead to panicking of a huge selling and from the investor side also. So I'll show you a table that shows the details of Facebook's option outstanding and option exercisable along with its exercise price. Let me show you that. These are the exercise price, these are the number of shares, and the options exercisable details, that are number of shares and the weighted average exercise price. Now let's see some of the taxability of stock options. See, to understand the tax aspects of a stock options, we need to understand the types of the stock options which are taxable. There are majorly two types, you can say, that is non-qualified stock option. First, non-qualified stock option. Non-qualified stock option, and the another one is basically, you can say, second, that is your incentive stock option. Okay, so these are the two types. Now, first, the non-qualified stock option. See, the stock options are sometimes referred to as non-statutory stock options because these options are openly for taxability. They are open for taxability. In other words, the non-qualified stock option are taxable. When exercised, the owner of this options has to pay tax on the difference between the predetermined price and the price at which the option holder exercises his or her option. So if the shares after the exercise is held for more than 1 year, the long-term capital gain is levied. Now there is another, that is non-qualified stock option example that we can talk about. Let's assume that an employee gets a NSO, which is known as the non-statutory stock option, or NQO, that is known as non-qualified stock option. So this option allows him to buy close enough to, let's say, 100 shares of the company of his employer at a predetermined price of, let's say, $25. So now the days the employees exercise his option, he or she will be eligible for the tax. So let's take the market price as close enough to 30. This is going to be your market price. So now the tax will be levied on the difference between the predetermined price and the price at which the option holder exercised the option. So in this particular scenario, what will happen? It will be 30 less 25, close the bracket, into 100. That gives us our answer as is equal to, just add $500, assuming that the employees have exercised all their options in one go. So if the option holders, after exercising the option, sells those shares, and short-term capital gain tax will be applicable in the same. So if the employees decides to hold the shares and sell after 1 year, long-term capital gain tax would be applicable. Now there's another thing that is called as incentive stock option plan. See, incentive stock option plan, which is known as ISO, are also referred to as incentive stock options or qualified stock options. This options gets basically, you can say, a tax benefit. They get basically a tax benefit. This means that no tax is applicable on the options at the time of the exercise, unlike the non-qualified stock options, that is NS and QO. So the owner of the option has to pay the ordinary income tax at the time of the exercise, as discussed. So nonetheless, when the option holder, after the exercise of the option, decides to sell the shares after 1 year, the long-term capital gain, that is LTCG, long-term capital gain, will be applicable, which is much more lower than the ordinary income tax. So there are several conditions which have to be met before the stock option can qualify as an incentive stock option. The conditions are somewhat like this. The option can only be granted to a current employee. So the employee should exercise during his or her tenure in the company or within close enough to, you can say, 3 months, okay, after the termination of the employment. Second, you can say the option must be granted under a written plan. Because that is basically a document specifying all the necessary terms and conditions related to the option. Third, the option should be granted before 10 years. It should be granted before 10 years after taking the shareholders' approval. Fourth, the ISO documents basically must state that the option is not transferable. It is not transferable to anyone except under the extraordinary conditions, death of the option holder, and in this case, the option will be transferred to the legal heirs of the deceased. Fifth, you can say that the employees must not own more than, so that should be less than 10% of the voting stock of the company at the time of the grant. Now let's understand the effects on the financial statement. See, if we consider this stock option as an expense, we would definitely have to recognize it after we recognize the stock option in the income statement. The net income will come down for that specific amount and it will impact the EPS calculation. So the impact on the income statement, you can say that, share-based compensation affects the first thing. I'll write over here that as income statement because that is the first thing that will get affected. So what will happen? There will be a decrease in income. Now let's have a look at Facebook, income statement. And here basically the cost and expense include the share-based compensation expense. This expense basically reduces the net income. And we'll also note that, in the Facebook has provided a breakup of the stock-based compensation included under each cost expense item. So overall in 2016, Facebook included close enough to 3,218 million worth of stock-based compensation. Let's have a look. Now here are some of the related costs. As you can see, cost expense, cost of revenue, marketing, general administrative expenses. Over here, there's this share-based compensation expenses. So, which is close enough to 3,218. So, this expense is directly going to hit your net income, which includes cost of revenue, research and development, marketing and sales, and general admin, which gives you total share-based compensation expenses. So, this is one effect, that is your income will be decreased. Second, there will be diluted EPS. So, when we calculate the diluted EPS, we take the impact of the stock options exercised by the option holder. When stock options are exercised, the company needs to issue some additional shares in order to compensate the employees or investors who have exercised them. So due to this, the total number of outstanding shares increased, resulting to lower EPS. Now I'll show you the Facebook's employee stock option increase in the total number of outstanding shares, thereby it is reducing the earning per share. If you see over here, the employee stock options over here, 6, 6, 8 and so on and so forth, it is in a way reducing the diluted EPS. You can see 3.49, 3.49, 1.29 and so on and so forth. So overall, the impact of the stock options on the income statement is to increase the expense, reduce the net income and increase the number of the outstanding shares. So all of which will result into smaller EPS. Got it? Now, let's see the impact on the balance sheet. See, there are several ways a company can compensate its stock option holders. Here, we'll consider the two ways of explanation purpose. First, the company can pay the difference between the predetermined price and the price of at the date of the exercise. That is, what happens, your asset, in case of your assets, your cash will go down, right? And your shareholders' equity will again go down. Now, second, this was the first thing. First, what? The company over here can pay the difference between the predetermined price and the price on the date of the exercise. So cash will reduce. Obviously your owner's equity will also get reduced. The second is the company has an option to issue additional shares in lieu of the stock options outstanding for the year. So what will happen? Let's see. Over here there is assets, liability. There will be increase in the paid up share capital because we are issuing in lieu of the stock options and the owner's equity has to go down. So this is going to be impact. If the company goes by the second option that we have discussed over here, right here, the company will increase the paid up capital in lieu of the issuing the additional shares. So what will be the impact on the cash flow statement? See, again, consider the two ways of compensating a stock option holder as discussed above. If the company goes for the first option, that is paying the difference in cash, then it will have to record the cash flow from the financing activity. That is in the first case that we discussed, they will have to disclose in case of financing activities in cash flow statement. Thus, the cash flow from the financing activities will be reduced by the same amount as the cash on the asset side of the balance sheet. So if the company goes for the second option of issuing instead of paying cash, then there will be no impact on the cash flow statement and no cash flow will happen. So finally, let's make a conclusion on this particular tutorial. Stock option based compensation is kind of a compensation that is given to the companies to its, you can say, shareholders. This type of compensation is commonly given by the startup companies, okay? And in order to lock in the executives for minimum number of years, the executives who are given the stock option based compensation can get a benefit only if they serve, this is very important, only if they serve the company for the specified period of time. So the most common type of the stock based compensation is ESOPs, that is employee stock option plans. These options may have a tax implication depending upon whether they are non-qualified stock options or incentive stock options. The companies can either show their cost associated to ESOPs in their income statement or in the footnotes. So if expense and reported in the income statement, the exercising of the ESOPs by the employee results in the reduction of the EPS. And if the company actually pays the difference between the stock price and the exercise price, the option holder, it results in reduction in the owner's equity and cash on the balance sheet, and a reduction in the cash from the financing activity of the cash flow statement. And if the company compensates the option holder totally in terms of additional shares, the paid up capital increases on the balance sheet while there will be no impact on the cash flow statement. Thank you everyone.